Very good evening to you all, friends. I am Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board. I welcome you all to this 102nd program of AASB for this council year. As you are aware that we are doing a series of programs on key consideration in audit of listed companies, and today is the 7th program, and the topic is risk assessment. To take this topic, we have two eminent speakers, CA Padma Shri Presto and CA Shraddha Kutsara, and the two moderators are CA Tushar Kapoor and CA Mayank Arora. Friends, risk assessment is very essential ingredient before starting an audit, because if you perceive to the risk to be low, medium, or high, that will impact our audit plan, that will impact our extent of check, that will impact our control testing and substantive testing. So it is imperative that an auditor makes a careful decision about the risk assessment and accordingly takes a decision. So I'm sure that this webinar will enlighten all of you and will help you in carrying out a proper audit by doing a proper risk assessment. I'm thankful to both the speakers and both the moderators, and above all the participants for taking keen interest in the programs of AASB. Thank you. May I now invite Mr. C. Tushar Kapoor to take the program forward. Sorry, Mayank Arora.
Yeah, good evening, ladies and gentlemen, our esteemed guests and seminar participants. It is my pleasure to extend a warm welcome and enthusiastic welcome to all of you on behalf of Auditing and Assurance Standard Board of ICI. We are honored to have Sanjeev sir, Chairman of AASB, and our Vice Chairman sir of AASB on this program to have their eminent speakers with us to deliver their lectures on standards on accounting. Our first speaker is Shraddha ma'am. She is a chartered accountant and company secretary with over 13 years of rich experience in conducting stat audits of automotive, manufacturing, engineering, renewable energy, IT, and ITES clients. She has managed audits of large listed companies which are part of Sensex 30 and Nifty 50. She has led India's implementation of one of the leading automobile and private sector pharma company. She has superheaded audit of standalone and consolidated financial statement of multiple listed private limited, public limited, and global companies by conducting stat audit as per Indian GAAP, Indian AS, IFRS, tax audits, VAT audit, and certification. On top of it, she has got practical and solution oriented approach without compromising any audit quality. She is a regular speaker on various accounting and auditing topics for seminars conducted by Auditing and Accounting Standard Board and Continuing Professional Education Committee. She has in fact moderated session on internal financial control for Audit Quality Cafe on initiative of ICI to enhance audit quality. She has done MCom from University of Pune along with BCom from University of Pune before doing chartered accountancy and company secretary course. Now I invite Tushar Kapoor to introduce our second speaker.
Good evening, everyone. I'm Tushar, and I will be the co-moderator along with Mayank for this webinar. And I thank Chairman Sir, Vice Chairman Sir for this opportunity. Well, to introduce myself first, I am working as an audit manager with one of the big four firms and have around 8+ years of experience in external audits. And I thank all of you for joining and taking out time for learning and development. I'm sure everybody wants to wrap up their work on a Friday evening and get into the weekend positively. And we have eminent speakers with us. To introduce our first speaker of the session, please welcome Ma'am Padma Shri Cresto. Padma Shri ma'am is a partner with A&A practice at MSKC and Associates and also heads the corporate legal function. She's head of monitoring and remediation in the firm. She operates out of Mumbai office and has over 20 years of extensive experience in practicing audit services, primarily in financial services and manufacturing. She has implemented ISQM in December 2022 and is responsible for coordination and conduct of all regulatory and global reviews and is part of global quality review team. Being a proficient speaker imparting sessions, she's also a member of Center of Excellence for Insurance topic working group on group audits. She's a special invitee to the A&A SP for the year 2024 and 25. And out of all, the most exciting introduction is that she has been awarded the title of Super Women of WIRC by WIRC of ICI in March 2024. So we welcome you, ma'am, to enlighten us on the topic SA 315 revised, identifying and assessing the risk of material misstatement through understanding the entity and its environment. I hand over to you, ma'am.
Hi, thanks to Chairman Sir Anilji and Mayank and Tushar for the warm welcome. Without wasting any, swiftly I will be sharing my screen. I request you to let me know if everyone can see the screen and also you can hear me clearly. Just sharing the screen. Yeah. Can you see the screen?
Yeah, ma'am, your screen is visible and we can
Yes,
hear
ma'am.
you clearly. Yep.
Yeah, wonderful. Okay. Yeah, so here we are on the audit of listed companies, one of the very key aspects, which is risk assessment, which is SA 315. So risk assessment, I would say, is the heart of audit methodology. As we all are aware, we no more do trial balance based audits and we do risk based audits. So identification and assessment of risk is the key. If we start off with the identification and assessment of risk appropriately, then I think we are going in the right direction. If we any time actually fail, or if we actually do not identify the risk of material misstatement appropriately, then we can say that the entire process of auditing actually will go into a different direction altogether. So it is very imperative and very necessary to actually identify, put appropriate thought process and identify the appropriate risks at the appropriate time. This is very, very, necessary that we spend appropriate time into the planning. So generally, if you see in India and abroad, when we speak to the regulators, when we speak to various, boards and other things, one of the things that we generally come to know is that how much time you should spend in planning of the audit. So planning of the audit should be such that you should consider your previous information that you have as a previous auditor or discussion with the previous auditor. You should be able to acknowledge, understand the various risks that are affecting the entity, which we will look into very much in detail. And you should be spending adequate time, more than 45-50% of the time into planning, so that once you plan well, then the tasks actually go smoothly, and then you are supposed to get the conclusions that you will be able to arrive at the conclusions. And this risk assessment also asks for a revision at a later time, which is also necessary, and then how you will look into the revisions as well. So with that as a quick thought process, I think it is very necessary for us to understand how the risk assessment is to be done. So to understand the risk assessment, what we will do is that, we understand the audit risk model, which we all know. So I have kind of tabulated the same thing, what is there in the theory, that there is inherent risk in the audit, there is a control risk in the audit, and there is a detection risk that you will always have to live with, because you are not doing 100% audit. Yes, more and more we are talking about IT enabled audit, and then IT GC involved audit, and then now over and above we are talking about AI enabled audit, isn't it? And then we are going about reducing the detection risk to the minimal. So the acceptable detection risk largely across is 3 to 4% or 5% maximum. So you can live with the detection risk of 5%, but then you can, if you're not doing your risk assessment appropriately, then your detection risk may go more, and that is actually your audit risk, right? So you have a business risk, which is risk to the business, and then you have a audit risk, which you carry, which is actually a multiplicator of your inherent risk, control risk, and the detection risk. So inherent risk, what is an inherent risk is that there are certain factors that make an entity vulnerable to certain risks, and there may be a business risk and then an audit risk. So what actually transpires into audit risk and which has inherent factors is something that can be termed as inherent risk. For example, if you are auditing a highly regulated entity, then it's by default, say for example a bank or insurance company or something like that, you're supposed to know the latest regulations. So every February, every January, you get master circulars, you get latest circulars, you get latest things, provisioning norms and things like that, which you're supposed to be aware of without fail. If you actually do not uh, think about that, or you do not factor in that, that may become your very big issue later, because the regulator may then pinpoint that I had few observations and or I had issued few circulars, why the company has not complied with and why the auditor has not actually reported on those things. You have to keep in mind such risks which are inherent risk. If an entity is, for example, is into food and safety, then complying with those regulations also become question mark on the existence of the entity itself. If they violate, say for example, if they are manufacturing some medicines and if they are not actually compliant with certain standards and certain requirements, then they will be having an issue with respect to existence. That is, their license may get cancelled, and that may get into a going concern issue itself. Control risk is something that the controls that the company has put in place is not working appropriately. So when we are looking at control risk, what we are supposed to consider is that we have to do a step-by-step approach, which we'll talk about a little bit in detail. That you have to identify the risk, you have to identify the controls that are actually there to contravene or to mitigate those risks. However, if the controls that are put in place, if there is a potential for failure of that control and that potential for failure is high, then it gives rise to control risk. So what is the probability that the controls that have been put into are either not designed properly or are not effective properly and they fail is the control risk. So actually responding to risk is how you design your procedures. So that comes into control design and implementation, as well as doing the control, which will be actually in detail covered by the other speaker today, Shraddha today. Detection risk, when you have identified your risk appropriately, when you have assessed your risk, and then you have put in procedures in place to actually mitigate your audit risk, the detection risk automatically goes down. Today in risk assessment, what are we looking at is that we cannot identify the detection risk directly, but then we can definitely mitigate the detection risk, and that is by actually identifying the proper risk of material misstatement, which is part of the inherent risk as well as the control risk. That is what we are going to more look at today. So what is potential risk? Potential risk of misstatement. If I can say, what is potential risk of misstatement? Potential risk of misstatement, risk of material misstatement, basically. RMM is risk of material misstatement. When we start the audit, we are still into the planning phase. We don't have much information, or there may be certain information which have changed over a period of time. At that time, whatever we identify, we generally end up calling it as a potential risk of material misstatement. And then when we actually go to the assessment phase, then we determine whether there is a risk or not. So at this stage, we generally call it a potential risk of material misstatement. Matters that are identified by the team. So let us break this definition into some pieces. What is it that causes risk? Matters that are identified by the team. By whom? By the team. It's not only by the engagement partner, it's not only by the engagement manager or the article trainee, it's by the team at various by doing various procedures, which we'll come to, which based on the team's knowledge at that point in time. That's very important. So when certain things happen, it's easier to tell us in hindsight what should have been done and what could have been done and what could have been better. But then, is the due diligence or is the appropriate diligence or is the appropriate knowledge applied to see that at that point in time whether those factors existed? So when we talk about any kind of any kind of orders, documentation lapses and things like that, what is it that the audit team had access to and how much had it done its work with diligence is what it matters, rather than certain things. There are orders in the public domain which you can refer to, wherein the documentation is the savior, or wherein writing and doing the proper procedures is something that has come to the saving of certain people. So a softer approach or a softer tone method is taken by the regulator if at that time, after doing all the necessary procedures as stated in the auditing standards, if they were not able to obtain that information, or if it is a deliberate concealment of information, if you are able to prove that, then the tone will change. However, if we have failed to do our own procedures, so team's knowledge at that point in time, so how does team get the knowledge? They have to do certain procedures to get that knowledge. If they have not done anything, or if they are not able to demonstrate anything, then I think the overall take will be on a completely different side, and that will actually cause more harm. So the procedures that we have to do to identify the risk that we are going to talk about today, that we will discuss. And then how does the team gain this knowledge at that point in time? They believe could result in assessed risk of material misstatement. They believe. Why do they believe? Because based on all these procedures, they are going to believe that this is something that was actually at that time that existed, which could result in an assessed risk of material misstatement. And that material misstatement can be due to fraud or error. So it can be either due to fraud or it can be due to error. Both can give rise to risk of material misstatement. Okay. So before we proceed further, let us talk about assertions. There are various assertions as per the audit methodology. Everyone is aware of. Different firms use different set of assertions, but the common ones that are used are completeness, whether all the transactions that has been undertaken during the year has been properly accounted for or not, whether the account balances are complete or not complete. Existence, whether the transactions that have occurred are existing or not, or the occurrence in terms of expenditure, and existence in terms of physical assets like the cash or the assets or the inventory existence. Then accuracy, whether the transactions are appropriately arithmetical accuracy and the properly recording of the transaction, so accuracy. And then valuation, whether the value at which the item is stated is the same carrying value, or if it has to be reassessed or something. So that's valuation. And then the presentation, which is actually overall presentation as per Schedule 3, as per Banking Regulation Act, as per Insurance Regulation Act, and things like that. And there are few others like the rights and obligations and things like that. So I think largely these are the assertions that are used. So we need to make sure of what is the risk and at which assertion level. So if we are saying that if it is a say for example a retail store and cash is susceptible, so then we are talking about cash and bank as a financial statement area, and then we are talking about existence as assertion. So when we are identifying risk, it is very important for us to identify the area and the assertion. If we don't do that, and if we take all the assertions, we will have to satisfy, or we will have to mitigate the risk on totality basis on all the assertions. So when we identify the risk, it is necessary to identify the financial statement area and the assertion. So that was one example. Second example, if you are talking about say ECL provision, if whether ECL provision is properly calculated, whether aging of the doubtful debts is properly done or not done. So if you're talking about that, then what are we talking about? We're talking about AR, that is accounts receivable or the trade receivable. And what is the assertion we are talking about? We are talking about valuation, whether the value that is stated about the data is appropriate or not. So we have to go to that level to see what is at risk. We cannot just say that accounts receivable is at risk. We have to go to that level that to say that what is at risk. Business risk. Many of the audit risk come out of business risk. So it is necessary for us to actually go through the business risk or the risk register of the company as well. So when we go through the risk register of the company, so we will come to know various things that they have jotted down as risk. As I gave few examples at the beginning, that if the company is into medicine manufacturing, drug manufacturing, then they may have a risk of regulator. If it's a RBI regulated entity, RBI inspections, curbing of certain practices, and also strict compliances with certain practices, all this can become a risk. So that can be a regulatory risk. If the company is into say smaller production of smaller products or some eatables or something, then what is the type of risk? What is the business risk? Then overall external factors that may be affecting the company, change in law, change in regulation, all this. So business risk we have to go through so that we can identify the proper audit risk, because some of the, not all the business risk will become audit risk, but these may actually give us the path as to how we can identify the risks in the financial statements. Internal control, this is very important. We are going to talk about the controls assessment and the design of the controls a little bit in detail. Internal control is how they have designed, because we're talking about listed companies here, audit of listed companies. So audit of listed companies everywhere, even IFC is also applicable. So what we are going to look at in IFC is the design and implementation of the controls, and then the operating effectiveness. If design fails, then the control fails. If the implementation fails, the control fails. And obviously, if the operating effectiveness fails, then the control also fails. So the first stage is design and implementation. So before we go to that, how do you assess the risk? We will first talk about that, and then we'll go to the control assessment. We'll talk about in detail. So when we are going to do the risk assessment or risk identification, before risk assessment, we have to do a risk identification, right? So when we do a risk identification, so there are certain things that we have to keep in mind. Number one, whether we have seen the documents that are underlying, whether we have made appropriate inquiries, whether we are going in the right direction, whether we have consulted with necessary people. If, say, for example, a client has a lot of legal cases, it is necessary for us to go and speak to the legal counsel also. We cannot sit and say that, okay, this is the status that was presented by the last year auditor. So we see that everything is provided for, so there is no risk. No, if they have a lot of legal cases, then it is imperative that we go and speak to the necessary auditors there. If it is a company which offers a lot of discounts, if it is into the retail or the manufacturing sector where there is a lot of discount, seasonal discount, regional discount that is available, then it is necessary for us to go out of the finance department and speak to the sales guy, and we have to discuss with him that what are the risks there. That is also necessary for us to do. Risk assessment procedures, everything that we are talking about or we are saying, all these things put together are the risk assessment procedures. So these definitions basically I have taken out from the SA 315, but I'm simplifying while discussing. Significant risk, we will come to that. Once we identify the potential risk of material misstatements, then we will have to classify the risks into what is significant and what is normal, and what is it that we are going to focus on. So significant risk becomes the focal point. That's the main list of risks that we have to mitigate, and say that the risk of the financial statements are free of material misstatements. When we are able to mitigate the significant risk, the overall basis that we have to conclude is, this is how we are going to conclude, and this is how we have got a comfort over the overall number of risks that we have, and this is how we have mitigated the risks. So understanding the entity, sources of potential RMM. How do we get onto the sources of potential RMM? First of all, we have to do the understanding of the entity. It is very necessary for us to understand the entity. Without understanding the entity, actually, we cannot do risk assessment or we cannot do risk identification. I have given 2-3 examples which you all are also very well aware. If you are not going in the right direction, if you are not understanding the business, and if you are not understanding the nitty-gritty of the business, we will not be able to identify the risk properly. So what is necessary for us to gain a knowledge? As per the essay, you have to understand the industry. Say, for example, if they are into a chemical industry, 2 years ago, some chemicals have been banned by the government because that was used for some illegal purposes. So what is it? What is the company manufacturing? Say, if they were manufacturing those kind of companies, and if a regulatory ban comes like that, so what is the susceptibility of the products to be in the public domain, or how is it that they are regulated? That is necessary. Then regulatory environment that we spoke about, industry factors like what is the demand, what is the percentage, how did they gain, how did they not gain, and what are the margins, what are the other pressures, are there fraud happening in that specific segment or the industry. All this we need to understand. Other external factors that we spoke about, if it is a worldwide issue, If it is so for example, the consumer goods effect was affected very badly during COVID period. The stock, the tourism industry, that got affected. So what are the other external factors that are getting affected, and because of which, what is the risk that the entity may face? The nature of the entity, or the type of operations. What are the type of operations? Ownership and governance structure. This is very important because at times there may be certain governance structures or ownership which need for specific reporting, or which are very stringent, or which are very liberal. So all of these can pose a risk, because as per Indian regulations, maybe that type of entity or that type of structure may be under stress, or it may be under some vigilance. So we need to understand the ownership governance structure of the entity as well. The type of investment that the entity is making and plans to make, including investment in special purpose entities. Why is it creating multiple layers, or why is it going into structuring which is actually having too many SPVs? For example, if you look at real estate companies, they have this practice of it's a business practice that every project is governed by one SPV, one specific entity. Then that becomes an industry practice. If otherwise, if multiple entities are there and then you will have to consolidate, you need to understand what are the risks arising out of that, and what is it that that entity is into. Is it into a different kind of business, or is it into similar kind of business? What are the risks arising out of the component that may affect your group structure also, or the holding company also? That is also necessary to understand. The way that the entity is structured, so whether it is equity leveraged, debt leveraged, what are the types of transactions? Is there a continuous stress on the balance sheet in terms of repayment of debt? Whether CDR is happening every now and then, whether the extensions are happening. So that can give you a sense of there is a risk in terms of the borrowing is taken, but however, they are not able to service the debt. So all this gives rise to risk. So individually, every audit will have its own path and direction as to how you will identify the risks. Also, the entity selection and application of accounting policy, including the reasons for change there too. Whether the management is super aggressive doing something that is actually not done by anyone in the industry, or they are doing the accounting policies that's largely followed in the industry. So how do they select? How do they benchmark their accounting policies? And when we do the financial statement audit, we also need to benchmark the accounting policies to other players in the industry, so that to see that we all at par, or if there is a completely different stand taken, if there is a complex accounting that is taken, then that may pose a risk. So if there may be some company which is saying that, okay, this is not written in the accounting standards, so I want to do this. So that may be aggressive stand. It's not done by anyone in the industry. So those kind of things have to be looked into when we are looking at the understanding of the entity. Also, the entity's objectives, strategies, and those related business risk, as we spoke about, which will result into the risk of material misstatement. It's not necessary that everything comes from the risk register. They may not have recorded, but only when you understand the business of the entity will you be able to understand what are the risks that are involved in that industry. So it may not be possible that everything comes on a platter and we have to go to different people and we will have to discuss it more and more over there. The measurement and review of entities' financial performance. This is very important, and this gives rise to a very, the normal, what do we call as significant risk, that is a fraud risk. So what are the entities' measurement and review of financial performance? So key performance indicators, if the bonus or the commission of the senior management, directors, anything which is related as a percentage of commission to the profitability. So what is the susceptibility of the profitability to be affected because of these factors, so which we call as management override of control, which can lead to any kind of adjustments in terms of adjusting all these factors, either deflating the expenses, inflating the expenses, inflating the income, or deflating the income, increase in profit, writing off something. So all these things have to be taken care of. A trend has to be seen, analytical will have to be performed. So this may give rise to potential RMM here, and understanding this becomes very necessary. I think this got repeated, sorry. Yeah. Then we can come to the understanding the controls. So when we talk about the understanding of the controls, there are various elements. One by one, we are going to discuss that. The control environment. How is the control environment? We all are aware of internal financial controls and the COSO elements, how the control environment is discussed, decided. Management and along with the those charged with governance has maintained a culture of honesty and ethical behavior. How does the management believe? How does the management look at certain things? Whether they are transparent, whether they are honest, how is their behavior? Then what are the strengths in the control environment which are there? And how does the management take the legal or other matters that come to them? How do they assess that what are the deficiencies in the control? Are they very open about it, or are they wanting to hide those things? So there are different types of companies when we go for audit, right? So someone actually tells you upfront even their problems, they will tell you upfront, and then it's easier for you to communicate, and they are open to communication, open to suggestions. But there are other types of companies wherein information is given only to the extent that you ask for. If you don't ask for, then that information is not given. For example, there may be a say GST notice or something. So if you generally ask that statement saying that, can you tell me anything more that I should know? So you didn't point out at GST, so he will say that you didn't ask about GST, so I haven't given. So it's possible that they are giving very limited information, or they ask you questions time and again. Whenever you ask questions, they are counter asking questions. So all this actually makes you think about how comfortable are you in doing the risk assessment, and what are the risks that you see. The entity's risk assessment process itself, so that is the risk register that we spoke about. I have they listed down all the risk register, and the entity's risk assessment process is appropriate. Is it getting revised year on year, or is it only once in a year that it is getting revised? Once in 3-4 years that it is getting revised, or only it is done for the sake of audit, or done for the sake of corporate governance, or is it a true reflection of the risks that they undergo? So the entity's risk assessment process itself as to how they identify the business risk relevant to financial reporting objective, estimating the significance of the risk, and then how often can it occur, what is the occurrence that we look at, and then how do they actually action to address those risks. So when we look at identifying the risk, we look at two things. One is the likelihood, that is the possibility of occurrence. Second is the magnitude. Magnitude is it, if it happens, then what happens, right? So there has to be a combination of both of these factors, then only it will become a risk. We can't remotely think that yesterday night I saw a sci-fi movie and then a UFA coming and invading the whole world. I think that's too much of us to think. All the employees of the company has like 2,000 employees and it is doing well, there are no issues, but then we assuming that everyone will leave tomorrow is not a risk. However, if there are continuous retrenchments, so voluntary retirements that the company is giving, then there is a stress on the staff position, right? And if you're in a zone where there is war or something is happening, then there is a question that you may get into some kind of a trouble. So the likelihood and magnitude have always to be thought of when we are talking about risks. And we talked about one of the risks, which is management overhead of control. There is another risk that we always talk about, which can be a significant risk and which may be susceptible to fraud, which is fraud in revenue recognition, risk of fraud in revenue recognition. So the risk of fraud in revenue recognition, when we are talking about, it can be inflated or it can be deflated as well, because there may be a question of taxation and other things, so revenue may be deflated. So you have to generally all the firms consider these two things as significant risk, and they will do work around this, though it is not very specifically written in the standard saying that these two has to be significant risk, but then these two are considered to be the significant risk by almost all the firms, and you have to negate it in the file because these two are always sitting there in the audit in the audit environment, is how we understand. Very important, the next thing that we spoke about is everyone has systems, everyone has processes. We need to have appropriate IT expertise to look at the system, understanding of the information system, including the business relation processes, which are relevant to the financial reporting. What are the classes of transaction? If there are multiple systems, how does the batch processing happen? How does the inter software transfer that happens? So the transfer of data from one to other, the batch processing or other type of internal assessments that happen. What is the type of the environment, the ITGC, which actually consists of the user management, change management, overall security management, and now we have the audit trail also, which has to be checked by the ITGC. So all this we need to understand very much in detail, and then what are the processes, what are the procedures which the IT team itself is looking at, and what is the BCP-DRP maybe of that entity, how they are going to bounce back, and also the manual systems, if any, and how are the manual controls working there. All these things are necessary to be understood and undertaken. While doing a risk assessment, it is also necessary to involve the ITGC guys who will have this system expertise and who will actually be able to identify risks in the IT system itself. Then the related accounting records, supporting information, specific accounts in financial statements, which are used to initiate record, process, transactions, etc. So all these things are also necessary to be looked into in detail. And it is necessary for us to consider all these factors while looking at the risk assessment. So the records may be in manual or in electronic form. So we will have to look into all these sources so that we do the appropriate risk identification. So if I have to put it in a small nutshell, to identify the risk, please understand the business, understand the controls, understand the ITGC environment, understand the processes that are done by the company, understand how they mitigate the risks, and then whatever gaps you see, we have to list down everything as potential risk first. So that gives us, say, 10, 12 potential risk, and each area wise and overall entity wise, right? So then after that, we will do a detailed assessment of each of the risk. Yeah. Further, we have to obtain an understanding of how entity communicates its financial reporting roles and responsibilities, that is each one's roles and responsibilities and the SODs that we see. Communication between management and those charged with governance. This is interesting at times. The TCWG or the board members or the audit committee members do not much rely on the senior management, and there are fights in the audit committee. We also see that, isn't it? So when there is such kind of a mismatch, then we have to look at that as well very much in detail. External communications, how transparent they are in external communications, and regulatory authorities, what is the tone maintained with the regulatory authorities, how much are the responsiveness, and what is it, say for example, there was one instance which was in the newspaper that the regulatory body kept asking for information, they ignored them. Once they said that, okay, you can't do it, you're supposed to do it appropriately, they ignored them second time, third time, and then the regulatory body came very heavily saying that you can't do business anymore. So such kind of instances, how are these things handled, and how are the entity responsive to how much is the entity responsive to the regulatory authority. Then we come to the control activities that are relevant. We don't want every control that is there out in the public. So maybe we are looking at what are the control activities that are relevant to the public. So we relevant to the financial statements, which are relevant to the audit and which are relevant to the financial statement. And that is why we are identifying risks that are actually very much relevant to the financial statement. So the controls that are relevant to maintaining of the transactions, accounting balance, and disclosures in the financial statements appropriately and meeting all the assertion requirements is something that is necessary for us, and whatever that arises from IT, that is also necessary for us. Then the next part comes into how they are monitoring these controls. So what is the frequency, what is the periodicity, how do they test those controls is something that we will have to look into. And if they are not testing, or if they are not doing that, or if they are not monitoring, so whatever is monitored may fail easily. So if they are not monitoring, that again can give rise to a risk, right? So once we have this list of 8-10 risks, then we classify it into engagement level risk and then assertion level risk. What is engagement level risk or entity level risk is something that is pervasive, not specific to certain parts, and it impacts overall behavior and our testing itself. For example, going concern. Going concern is an engagement or an entity level risk. So engagement or entity level risk is something that is actually there, which affect all the financial statement line items or all the financial statement areas, and that we may have to respond in a different manner. Whereas assertion level risk, so some of the receivables may not be good in value, they may not be receivable. Say inventory has an obsolescence issue, all these things are entity or are class specific or assertion level specific. However, sometimes a single individual line item may actually become so pervasive to the balance sheet and the entity that it may become engagement level risk. It may pose a question mark on the entire entity. For example, if there is only receivable in the balance sheet, which is the largest item, which is say 80% of the balance sheet, and if the receivable itself is in question, then the going concern comes into question. So we will have to every time look at the risk, we will have to classify it into three things. One is whether it is engagement level or the entity level one or the assertion level one. Second, whether it is significant or it is normal. And obviously third one, whether it is whether it can have a susceptibility of fraud or otherwise. So we have to classify every risk into these three things, and then only we will be able to further do the procedures. So types of risk, as we said, that significant RMMs are those RMMs which in our judgment require special audit consideration. So prima facie, when we are making this judgment, we exclude identified controls related to that risk. So we generally look at that what is more significant there. And assertion level, this is the assessment of risk, is the assessment of level of RMM for each scoped in financial statement area assertion, taking into consideration aggregation of all risk of material misstatement and significant material misstatement, which we have assessed relevant to each of these assertions, right? And matters identified by the team, which based on the team's knowledge at that point, they could believe and result in RMM either due to fraud or error. We saw this definition earlier. So basically, when we assess the risk, then we classify into significant and those. So coming to risk assessment, in excess, we have to exercise professional judgment or professional skepticism in concluding whether this risk is because of a risk of fraud, whether it is due to some recent significant economic, accounting, other developments, change in regulatory matters. We've given a lot of examples for that. The complexity of the transaction, say 109 provision for ECL, all this may be complex financial transactions, or dealing in a crypto, how to account for and things like that. And then whether the risk involves significant transactions with related party, how transparent it is, what are the significant related party transactions, degree of subjectivity of measurement. So whether it is so complex or the degree of subjectivity of measurement is more, that is the potential of the control failure may be higher or lower as the case may be. So we will have to look at how much is the subjectivity. So say for example, if it is a discretionary discount that can be given to certain high-end parties or something like that, how much is the discretion that he is using? Is it based on some numerological assessment that if he crosses 10% of his turnover, then he will give this much discount, or he can apply his own discretion? So that also may give give a question mark on the risk assessment. And also whether the transactions are within the normal course of business or they are unusual. So unusual ones always pop a question mark for assessment. So when we identify that a significant risk exists, we have to furthermore obtain understanding of the entity's control activities, including the control activities that are relevant for that risk. So we have to mitigate it. So we will have to identify that very much there. Few pointers on risk assessment. Information that are obtained by performing risk assessment procedures may be used by the auditor as audit evidence. So how do you do it? First we go and do the inquiry procedures. We understand each of the systems, say the sales cycle, the purchase cycle, the revenue cycle, the purchase cycle, and the inventory cycle, and things like that. Then we do a complete walkthrough of the process. We take one sample and see whether whatever is explained to us exists. And by doing that, we identify the gaps, controls, and also the gaps and the controls, that is the risk and the controls both. And then we look at the design and the efficiency and the implementation of those controls as well. That will be our next step. That's how step by step we are going to do the risk assessment. Auditor has always to use the professional judgment, what is required and what is not required. So it's said that every audit is different than another audit. It may be similar in many ways, but there will be something obviously that is different in each of the audit, and we have to keep it in mind and continuously keep applying our professional judgment in identifying and assessing the risk. and especially the classification of risk as significant and non-significant. So the risk that we have to assess includes both error due to error and fraud, and both are covered by this essay. However, what are the susceptibility of certain financial statements to certain financial statement areas to fraud is something that is more in detail in essay 240. So all these examples that we give to evade those things, if there is an intentional or the deceit that happens, then it converts into fraud. So if it is error, it is still it's still understandable. But if it comes to fraud, then the depth of the things that we have to do, the detailing of the things that we have to do furthermore increases. And along with that, we cannot forget 143.12 reporting, if it is above the thresholds, reporting to the board and things like that. So at all times when we are doing the risk assessment, we have to keep in mind the susceptibility of the financial statement area for fraud, and that has to be always a question mark, and we have to keep asking that question again and again, though it is a little bit uncomfortable question that we may have to write. Gathering some external information, trade economic journal, some reports by the analyst, etc. If we have some independent information, then that can be used for risk assessment as well. Making inquiries to external legal counsel, valuation expert, we discussed about this. If they have a lot of litigations, if they have larger litigations, then it is good to go to the external legal counsel and ask. Additional inquiries we can always do to the TCWG. This is also required as per SA 240. You have to do inquiry with the TCWG to understand if there had been any such cases. Inquiries of employees who are actually doing the transaction, who are at various levels of the transaction. Inquiries to in-house legal, as they have a lot of information, as we discussed about. So all these can be different approaches, ways of doing the risk assessment. Analytical procedures, we can compare with the budget, we can compare with last year. If there is a significant deviation, we can ask for reasons. Then observation, inspection, we talked about walkthrough, and we talked about design and implementation. Information that we have in prior periods, if there are too many errors or if there is a fraud in the previous year, what are the actions that are taken to actually mitigate that risk is something that we can look at. Industry, regulatory, other risk, external factors we spoke about. Nature of special purpose entities, we spoke about this as well. Entity selection and application of accounting policy, whether they are too aggressive or they are normal. Measurement and review of entities financial performance, that is MIS, KPIs, and how they are controlled and whether that is giving rise to any kind of risk. Journal entries, unusual journal entries, and few of the journal entries which are risky, who is passing it, who is approving it, what are the days on which it is done. So that's also necessary to do the assessment of risk. Related business processes, so if there is one business and then there are some related business processes, we need to understand that also, to see that whether something is being routed through somewhere else and whether there is any risk over there. On the basis of all this, we then make the risk assessment. Here, in respect of some of the risks, we judge that if not possible or practicable to obtain sufficient appropriate audit evidence only from substantive procedures, we may have to go to control based procedures. However, we are talking about listed companies. We are largely talking about first going through the control based approach, and then if not, then we will come to the substantive approach. So we will have to look at the automated processes, manual processes, control-based approach, and then go to the substantive process as well. There may be a revision required to the risk that initially at the planning stage you thought that there is no risk or the risk is just normal. But then later on, while doing the procedures, you come to know that there is a higher susceptibility of risk of certain areas. So it doesn't stop you, the standard doesn't stop you that you can't revise your risks. You can go back, revise your risk, add another control, do some more procedures, and then conclude on it. And if you're uncomfortable, then you can obviously report it in your auditor's report. So whenever during the execution play phase or during the closing phase, if you come across any significant risk, you are supposed to make changes to the planning and then add an additional memo to the planning to say that there has been additional risk that you have identified, and then you will have to also see how it is getting mitigated. Or if it is not getting mitigated, then reporting appropriately. There is an important section called engagement team discussion. So different people have done, at least gathered information. They have done inquiries. They have done walkthroughs, they have done the process understandings, everything. So they all have identified risk and they all have identified few controls. There has to be an engagement team discussion, which consists of which actually wherein the experienced people will talk about their experiences. There will be involvement of EP, EQR experts, IT, GC people, everyone. And then you will confirm your risk assessment. Then you classify your risk as to whether it is significant, normal, or it is not a risk. So this document has to be prepared, which is an engagement team discussion document, which you will put into place and then say, this is how I have assessed my risk. And then determine the RMM levels, which actually drives level of work we perform. If it is significant risk, then you will have to perform more work. If it is no risk, then you have to perform lesser work as compared to significant risk. So this is an important step where everyone gets together and discusses the risk and documents it properly, right? Communicating to the TCWG, as per the standard, you are required to communicate to the TCWG, auditor's responsibility, the management responsibility. What are the risks that you have identified? If you have fraud risk, then the discussion, identification, as well as the assessment of the fraud risk. Then the risk assessment, what is a significant risk and what is a normal risk to you, and what are the responses to the risk that you are planning. Basically, the audit plan. You have to communicate all this uh, to the TCWG and any other relevant points that are relevant for that specific this thing. So SA 315, there are documentation requirements also over and above SA 230, right? So what are the documents that you require? Auditor has to document a discussion among the engagement team, which we spoke about the engagement team discussion, right? And the significant decision that have been reached. Key elements of understanding obtained. So all the processes, everything, what all you have done, understanding of the entity, internal control, controls relevant to the audit, ITGC, everything has to be documented in short. And then what are the identified risks, what are the assessed risk, how is it classified as significant, normal, that you need to document very much clearly. And then the risk identified, related controls uh, about which the auditor has obtained an understanding, that also has to be appropriately covered. So I think largely that's it about the risk identification and assessment. I know this is a very doc, uh, vast topic to discuss in 1 hour, and I actually have tried to kind of crush the content into the crux material. I have tried to crush into this 1 hour. Risk assessment or risk identification and assessment is a topic which you can actually take for a day or a couple of days in each of the stages, like understanding the entity or understanding internal control. You can have 4 hour session for each of these things. But then since we are doing all the listed company audits, this is a kind of a quick crux that is actually I have tried to put together here, and that's what I have tried to discuss over here. I think we will have the question and answers at the end of the session, right, Mayank ji, if you can confirm that.
Yes, ma'am.
Yeah.
Thank you so much, ma'am, for enlightening us about the SA 315. I feel, in fact, much more informed now. Your insights and advice have been incredibly valuable to us. Now, I invite our next speaker, CA Shraddha, ma'am, who holds excellent academic record with highest degree of CNCS, that too cleared in first attempt. She has over 13 years of rich experience in conducting stat audits. Currently, she is working as a partner with the Big Six audit firm. She has managed audits of large listed group companies which are part of Sensex 30 and Nifty 50. She has led India's implementation of one of the leading automobile and private sector pharma company and spearheaded audit of standalone and consolidated financial statement of multiple listed private limited and public limited companies. She has delivered training on Ind AS accounting and auditing standards, as she is a regular speaker on various accounting standards and accounting topics for seminars conducted by AASB and CPEC. She is an effective leader with excellent motivational skills. Now I hand over to ma'am. Please share your valuable insights on SA 330. Shraddha ma'am.
Yeah, thank you, Mayank. I'll just share my screen. Mayank, is the screen visible?
Yes,
Yes,
ma'am.
ma'am.
Okay. So first of all, a very good evening to everyone, and I would like to take this opportunity to thank Sanjeev ji and Anil ji for inviting me to have a deliberation on a very important topic here regarding risk assessment. So I think we already saw, and Padmashri took us through the important aspects of SA 315, wherein we need to understand the business to do a risk assessment. Now, I will today take you through another standards on auditing, another important standard on auditing, which is around auditors' response to the assessed risk. So, as we saw in SA 315, engagement audit team needs to look at needs to perform the detailed understanding of the business and its environment, and then identify risk and assess what are the specific risk in that particular engagement. So once the engagement team does the understanding of the entity, its environment, and come to a conclusion of certain risks which it has identified, then comes an audit plan, or then comes an auditor's response that how would you mitigate the assessed risk. So as the risk assessment identification aspect is important, similarly once you identify a risk, it is equally important that you have an appropriate response, or you perform appropriate audit procedures to make sure that there is sufficient work done, or there is sufficient evidence which is collected to mitigate the risk which have been identified on the engagement. So if we look at the SA 330, which is auditor's response to assessed risk, the scope of an SA is more about the design and implementation of the responses to risk of material misstatements which are identified by an auditor. So basically, as we say that the audit starts with a planning phase. We plan the engagement, we do the understanding of business, we understand management processes, internal controls, and then we finalize our risk. Once we finalize the risk, then you also need to finalize the auditor's response to audit assessed risk. So it is equally important that you come up with the responses which you as an engagement team will perform to address the required risk. Now, the responses will be at various level. One would be the overall responses. That means what would be the audit procedures which an engagement team would perform when it would be responding to a risk of material misstatement. So take an example of revenue recognition. Generally, revenue recognition is a default fraud risk and a default significant fraud risk on every engagement. So here, the expectation is the engagement team come up with an overall response to address the risk of material misstatement which has been identified. However, having said that, generally not the entire revenue recognition may be a fraud risk. There would be a specific assertion. So, for an example, take a manufacturing company where we believe that cutoff or whether revenue is recognized in the correct period is the risk on the engagement. Then you need to make sure that you have responses to the entire revenue risk, but you have additional specific procedures which are designed to address the cutoff risk. Why? Because you as an engagement team believe that cutoff or recognition of revenue in a correct accounting period is the risk. So the point which I am trying to explain here is, as and when you identify any significant risk or any fraud risk on the engagement, make sure that you do additional procedures to mitigate the risk, because we are saying it's a significant risk. It's not a normal risk. So it can't be a scenario that you identify a significant risk and perform only normal audit procedures, which any which ways you would have performed. The moment it becomes a significant risk or a fraud risk, then basically your focus on that area and the level of procedures which we are required to be performed would be much more as compared to a normal risk. So whenever an auditor is designing the responses to assess risk, the first of all, the most important thing is there has to be an overall response which an auditor will have to design for each line item at financial statement level. Then comes the audit procedure, which are responsive to the assessed risk at assertion level. So, for an example, take debtors. If provision for doubtful debts is considered to be, say, a significant risk, then there has to be specific procedures around the valuation assertion which an audit team would have to perform to mitigate it. So basically, whenever you identify a risk, it is not only a general identification of a particular line item, you will have to assign specific assertions or specific reasons because of which an engagement team is identifying a risk. And for those specific assertions which have been identified, there has to be very specific procedures which are designed at an assertion level. So we are talking about two things. One is overall response and one is assertion level response. Next important thing is, once you have an overall as well as assertion level response, then and the procedures are performed, then as an auditor, you need to see whether you have been able to get the sufficient and appropriate required audit evidence. So basically, the audit evidence which you would have collected by performing your test of controls, substantive procedures, or substantive analytical procedures, we will go into details of test of controls and stuff like that. But what we need to understand is, once you perform the procedures, at the end, you need to evaluate whether those procedures were sufficient and your risk is appropriately mitigated. That is a very, very important point. And then comes the audit documentation. Documentation, as we rightly say, that whatever is not documented is not done. So it is very important that we have appropriate responses to the identified risk. We perform our procedures and we document it thoroughly to make sure that tomorrow, whenever we need to defend the work which we have performed, we have sufficient audit procedures and documentation available with us to defend the same. Now let's look at what procedures will you perform. So we spoke about having an overall response, having response at an assertion level. But what would be the response? What procedures will you perform? So there are generally two types of procedures which are performed. One is test of controls and another one is substantive procedures. So basically, audit procedures which we perform to evaluate the operative effectiveness of the controls, which helps in preventing or detecting the risk of material misstatement, is what we perform as test of controls. Since we are talking about audit of listed companies, wherein ICFR or internal financial controls would be applicable, test of controls is what we would be required to perform by default. So the audit procedures will start by understanding the process, which is understanding a particular cycle, then performing the walkthrough procedures, and then coming to the testing the design and operating effectiveness of the controls. So that is one way. Test of controls is one way to, I would say, to have an appropriate level of audit evidence for the risk which have been identified. Another audit procedure which we perform to detect the risk of material misstatement is test of details or substantive procedures. Substantive procedures is basically where we do a detailed verification. Generally, it is called as TOD, or where you, for example, you send confirmations, you take responses, you do recomputation of the workings, you do sample verifications. All these procedures are test of details. So in substantive procedures, in addition to test of controls, an auditor will perform detailed testing as well as substantive analytical procedures. Now, what are substantive analytical procedures? Substantive analytical procedures are broadly analytical procedures which will help you to obtain an evidence whether the balance which is there in the financial statements is appropriate or not. So if I have to give you an example, take an example, simple example of rent expenses. So in case of a substantive analytical procedure, you will take a rent agreement from the client, and basis the rent expense which is agreed in the agreement, you will compute what would be the expected rent and compare it with the actuals and see whether the results are appropriate or not. That is kind of a substantive analytical procedure. Another example could be depreciation. So in case of a depreciation, you can do a detailed recalculation, or what you can do is you can take the block of asset, you can take the life of assets and do a computation with some assumptions and compute the expected depreciation number. So these are certain examples of substantive analytical procedures. So in addition to test of controls, substantive procedures will help an auditor to make sure that sufficient and appropriate audit evidence has been collected. So when we design, or when as an auditor you design and implement the overall response to address the risks which we have identified at the financial statement level, there are 4 or 5 critical things which we should keep in mind. So whenever you are designing your audit procedures, please keep in mind that there has to be a specific consideration to ensure that the audit team needs to maintain professional skepticism. We will discuss about this words professional skepticism in coming slides. But the most important thing is the audit team member need to be very vigilant and apply their judgment and apply their skepticism as and when they would be performing the audit procedures. So rather than taking the audit evidence at face value, it is very important for us in today's world as an auditor that we challenge what comes to us. It is very important that we look at it from various lenses to ensure that the financial statements are free from material misstatement. Another important point is to ensure that there is appropriate skepticism which is applied on the engagement. It is important that experienced team members who have requisite knowledge as well as skill sets, who have performed a particular kind of work, are assigned on the engagement. So the engagement team has to be combination of few new team members as well as experienced team members. Whenever there are areas where there is a significant risk or a fraud risk or significant issues are identified on the engagement, it is always better that the experienced team members take look into those areas, as they will have the requisite skill set as well as they will have the requisite, I would say, mindset and professional skepticism to apply on those areas. So it is very important that when you do the planning of an engagement, there has to be a lot of emphasis on applying the skepticism and assigning right people to do the right job. If people are not aware, or if we have all new interns who would be performing the audit, obviously we there would be issues because of the lack of inexperience which may come up. So it is very important that right people are doing the right kind of work. Another most important aspect for us to assess that the audit team has done appropriate work on a timely manner is a detailed supervision. So it is very important for the engagement manager and the engagement partner who would be signing the financial statements, to be involved in the audit and to supervise the work which is done by juniors. So it is very important that we take the stock at appropriate time, guide the team members as and when it is required, or as and when we come across new findings on the engagement. So the engagement partner's responsibility is to ensure that appropriate guidance has been given to the team members so that they can perform the procedures well in time, and all the required procedures are performed. Another important parameter or another important aspect which we should keep in mind while responding to the risk is incorporating an element of unpredictability. So when it comes to the fraud risk, it is always said that we need to be very skeptical, as well as the audit procedures has to be unpredictable as well. So at times what happens, if we are auditing a client for say multiple number of years, the audit procedure becomes very routine from client's perspective. They know what elements auditor would verify in a particular area of financial statements. So for us as an auditor, in every audit engagement every year, it is important that we incorporate certain unpredictable procedures so that it helps us to make sure that the risk of material misstatement is further detected or minimized. We will talk about what kind of audit unpredictable procedures an auditor can incorporate, but it is important that those procedures are incorporated. Another important aspect is making changes to the nature, timing, and extent of audit procedures. So basically, at times, suppose it would be important that a team perform substantive procedures at the period end rather than at interim date. So obviously, if you perform the procedures on a balance sheet item at year end, the audit evidence which you will get would be much more pervasive as compared to the interim date. Even if you perform procedures at an interim date, it is required that you do the roll forward procedures and make sure that you perform adequate procedures because you are commenting on the financial statement as at particular period end. So the nature, timing, and extent of procedures, when to perform which type of procedures, what areas to cover in interim, what areas should be covered as a part of final evidence. I think that is very, very important when an auditor is designing the overall response to the risk of material misstatement. Now, we saw that when we are designing the responses, professional skepticism is very important. Now, this is a very talked about word in various ISAs. You will find reference, especially in ISA 200 and 240. You will find a lot of reference to professional skepticism being exercised by the auditor. So the question comes, what is professional skepticism? So professional skepticism is an attitude that requires a questioning mind, that requires an auditor to be very alert to to conditions that may indicate a risk of material misstatement or a risk of fraud. So basically, having a questioning mind and being a very alert individual and looking at the situations or conditions that are existing around you when it comes to audit is nothing but a professional skepticism. Now, what could be an example of professional skepticism? Now, suppose you are doing an audit of a company and you have performed an understanding of business. When you sit and do the verification or when you corroborate the understanding, you get certain evidences that are completely contradictory to what was your understanding. That is nothing but that is an alarm for you to ensure that in case the understanding is contradictory, there could be something which we may have missed out, or there could be an indication of an error or a fraud. Take another example. Suppose the information that comes into the question, so you are provided with some sort of information, and the information which you are verifying, there is a question on reliability of the documents on which you are relying upon as an audit evidence. Again, you need to be very alert to see, you need to apply your professional skepticism to question whether the documents which are provided to you are reliable or not. Many times what happens is we pick up samples and we verify the supporting documents. So when you verify the supporting documents, you may have all the documents being attached, which would support the, say, take an example of an expense, which would support the expenditure which is incurred. But then you need to apply your skepticism to understand that whether the expenditure incurred seems reasonable considering the way the company's products, company's business. Do we believe that this type of expenditure or this quantum of expenditure would have been incurred by the client? So I think that these are certain questions which we need to understand. So what we are trying to say is, don't blindly rely on the documents which are provided. We need to see whether those documents make sense, whether it seems to be reliable document. It helps, I mean, it gels with your entire understanding of the business. It seems to be routine one, it seems to be an expenditure which a business will have to incur. So all such type of questions are required to be asked when you do an audit. So it's not only about existence of supporting document, but it is about whether those documents are reliable, whether you believe those documents, those expenditure would have been incurred into the normal course of business. Another example, so basically professional skepticism is required to be applied at every stage of audit, being at planning phase, you being at evidence gathering phase, or you being at conclusion when you are evaluating whether what are the misstatements which you would have identified and you are evaluating and concluding on an audit. At every phase, it is important that we apply a professional skepticism. Another area where you can apply a professional skepticism or a classic example could be on estimates. Take an example of, say, trade receivables. Management may have a provisioning policy or an ECL model which has been followed. But however, as an auditor, since there is a lot of estimation which undergoes the calculation of it, there is a degree of judgment which is involved. We as an auditor should challenge the management estimates on subjective matters like this. So when it comes to fair valuation, when it comes to estimates, there is a risk of estimation uncertainty. And therefore, it is important that we challenge management to obtain the required evidence or to satisfy ourselves that the numbers or the assumptions which have been considered by management are appropriate or are sufficient or are reasonable, so as to say. Take an example. Suppose if in case you are doing an audit and management, you want to obtain certain external confirmations, but management doesn't allow you or management refuses the auditor's request to obtain the evidence from a third party or an external confirmation, then you need to be extremely skeptical what could be the reason because of which management is not allowing you, because third party evidence is the best form of evidence or the most persuasive evidence which we could obtain as an auditor. So rather than relying only on the evidence provided by management or taking certain aspects noted in I would say management representation letter, it is important as an auditor that we apply or we obtain more and more of third party evidences. So basically, there could be n number of examples or situations which may arise in an audit engagement where you, as an auditor, if you apply skepticism, would have done something else or something additional to obtain a required level of evidence. The most important thing is we need to keep our eyes and ears open to understand or to come across such situations and then apply our skepticism. Another important aspect is whenever the junior team members come across such situation, it is important that they go back and discuss such situations with their engagement managers or engagement partners, take their buy-in, take their experience, and then come back and perform those procedures. I think it is very important that the team members who are working on the field, they are very vigilant on their engagement and note all such situations and then go back and discuss it, even if they are not able to have a solution by themselves. I think the engagement manager and partner will have to then guide the engagement team to ensure that appropriate skepticism has been exercised. Another important element which we spoke about was regarding unpredictability. So basically, what happens at times, the audit procedures are extremely known to the client because we have been doing or dealing with a audit in a similar manner for year after year. So it is very important that on every engagement, you incorporate some part of unpredictability every year. Even the ISA 240, which is regarding the assess risk of material misstatement due to fraud, it also talks about incorporating an element of unpredictability in the audit procedures. Now, what could be an unpredictability in the audit procedure? Take an example. If you're carrying out physical verification every year on 31st March, at times it is important that you do it at interim period, or if management is doing say cycle count, you visit few cycle counts, observe those cycle counts. It would be a testing of your control, as well as it will be an unpredictable procedure which you can perform to make sure that the physical existence of inventory is there. There could be n number of such procedures which we can perform. In case of say group audits, there are multiple components. If you have been if you have been in scoping few components year on year and outscoping few of them being immaterial, on a rotational basis, we can at times also in scope some immaterial components to see whether everything is going right there. So I think such procedures can be incorporated in an audit and should be incorporated in every audit to make sure that we have something new or unpredictable when it comes to the audit procedures, and which will further enhance our ability to address the risk appropriately. Another important element is again the nature, time, and extent of audit procedures which will be performed at the assertion level. So another important point is whenever the audit procedures are designed, make sure that each assertion is covered. Each assertion is covered or each assertion is planned. There are procedures planned around each assertion. So take an example of say debtors. For debtors, we may have done a lot of work around, say, existence of debtors. We may have sent external confirmation, taken responses. Where responses are not received, we may have done further procedures and stuff like that. But we have not spent a lot of time on valuation aspect. However, valuation may be the maybe a higher risk for you as compared to existence. It depends upon engagement to engagement. So what I'm trying to tell you is make sure all assertions are covered appropriately based on the identified risk. If the risk is normal, still you will have to do some normal audit procedures to mitigate the risk. So that is very important that assertions are covered. Otherwise, what happens is engagement team ends up doing a lot of work on one or two assertions, but miss out on the rest of the assertions. That should not be a situation for any financial statement line item. So when you design the procedures, there has to be overall procedures as well as procedures at assertion level basis the risk identified. Now, we spoke about how will you obtain evidence. We will obtain evidence through test of controls, and we will obtain evidence through substantive procedures. Now, let's look at test of control in greater detail, because this essay talks about a lot of procedures through test of controls. So when we design and perform test of controls at assertion level, when we expect that the controls are operating effectively. So basically, in an ICFR scenario, it is mandatory that we go back, we do the walkthroughs, and we test the design of the controls. In case if we conclude that the design of controls is ineffective, then obviously ideally there should be another compensating controls, or then we conclude that the control environment itself is ineffective. If the design of the controls is effective or the design is appropriate, then we should go ahead and test the operating effectiveness. So basically, then we should take the entire year under consideration under the audit period and perform our control testing to see whether the control was operating effectively throughout the year. That is extremely critical. Another area where we perform the test of controls is where substantive procedures alone cannot provide you sufficient appropriate audit evidence. So, in cases where you need to report on controls as well by default, in case of ICFR, for all significant cycles, you will any which ways will have to perform the control procedures. There could be certain areas where substantive procedures may not provide sufficient audit evidence. In those areas also, control testing is something which would be required by the auditor to perform. If an auditor intends to rely on the operating effectiveness of control, he need to see the nature, timing, and extent of substantive procedures. What do we mean by that? So if auditor concludes basis is walkthrough at the design effectiveness testing and the design evaluation that the controls are designed appropriately, he should first perform the operating effectiveness test of those controls. After testing the controls, if we conclude that the controls are operating effectively, basis that the extent of substantive procedures may reduce. So, take a scenario where you are relying on controls, the evidence from controls is high, then the evidence from substantive procedure would be comparatively lower. And take a scenario where you are not relying on controls, then you will have to take the entire or obtain the entire evidence through substantive procedures. So it is very important, or I would say it is recommended that we should always go through the controls approach, obtain an understanding, see if the controls are designed appropriately and are operating effectively. If that is the scenario, we should then rely on controls and then move and take the evidence from substantive procedures. However, if that is not a scenario, then you will have no option but then to move directly to substantive procedures. How do we test the control operating effectiveness? So we mentioned that we need to obtain an understanding of the process. We need to perform the walkthrough, and then we need to look at the design of the controls. So from a design perspective, if everything is fine, then we do the operating effectiveness test. So when we would be doing the operating effectiveness test, inquiry alone is not sufficient to support the operating effectiveness. So take an example of say physical verification. Inquiry with management to say whether you have carried out physical verification through cycle counts is not sufficient. You need to have a combination of inquiry with either observation, inspection, or reperformance. Generally, inquiry combined with inspection or reperformance gives you higher level of evidence. So in case if you intend to take high level of evidence from controls, it is recommended that you do a combination of inquiry, inspection, or reperformance of controls. However, in case you don't intend to take high level of evidence, then you can decide to do a combination of say inquiry and observation or inquiry and inspection in certain controls. Inquiry and inspection can also give you high level of evidence, but it depends on control versus by control. But please keep in mind one thing, only inquiry will not give you sufficient evidence. It has to be inquiry along with other procedures. If we look at the audit evidence, now when it comes to control, we looked at the operating effectiveness of the control. Another important point is there would be two types of controls. One would be manual control and another would be automated control. If we are relying on the systems, or suppose a client is using a complex ERP for recording its books of accounts, it is important that we not only test the manual controls, but we also look at the automated controls which are there, which helps in the processing of the transactions automatically. So whenever you are designing your audit procedures, make sure that you include your IT team or the IT experts to test the system related controls, to test the IT general control part, to test the automated control part. Because in today's world, where the transactions are happening at a very faster mode, volumes are increasing, clients are doing more and more of digital related transactions or system generated, I would say automated transactions. So only testing of manual controls may not provide you the required level of evidence. So we will need to keep this aspect, very important aspect in mind when we are doing planning. We should obtain an understanding of the systems which client is using, how they are using it. We should look at the RCMs carefully, the risk control metrics, and see how many are automated controls, how many are manual. And for automated controls, the IT specialist should be involved to test those controls. So it's not only manual, but it is manual plus automated, which needs to be tested when engagement team intends to place reliance on the controls. Another important aspect is around rotation of controls. Now, though using audit evidence obtained in previous audit is allowed, however, before we decide that we will not obtain evidence in the current year and will rely on earlier year evidence, or in simple language, it is called as rotational approach of controls, where you would have tested a particular control in earlier year. So you did not test that control in the current year and rely on it. However, when you decide to take such approach, be very cautious because there are certain conditions which are prescribed in the standard as well as the ICFR guidance note. So before you say that we would rely on the previous year audit evidence, you need to be very sure whether there has been change in the control. You need to do an understanding and be very sure that the control operator or the control is operating the way it was designed earlier when you had tested. There are no change in facts and circumstances. And what another important thing which you need to which you need to also ensure is controls need to be tested at least once in every third audit. So if suppose this is a first year engagement, you can't take any rotational approach. If it's a second year engagement, you may decide, but then it depends upon engagement to engagement, because in the earlier year, if you would have come across certain deficiencies, you may would want to have sufficient understanding of the business and sufficient experience with the engagement with the client before you take a call to say have a rotational approach of control. Make sure that the controls are tested at least once in every 3 years. But I would suggest that before you go through that approach, please read the guidance very carefully, because there are a lot of conditions which are mentioned in the guidance before anybody applies a rotational approach. And obviously there is a lot of judgment also involved into it. Another important aspect is if you have identified a significant fraud risk, then it is not very recommendatory that you apply this approach, because it is then required that you have that required audit evidence in the current year to mitigate the level of risk. Now, another question is extent of control testing. So how many controls to test? What would be the frequency? What would be when to test? Whether it should be tested in the interim period, whether it should be tested at a particular point in time. It all depends on circumstances or a control to control. So basically, the extent of TOC, there are certain factors which we should consider. So frequency of performance of control is very important. So control, if it is operating on a yearly basis, obviously then you will test an yearly control. But if there is a control which is operating at every transaction level as and when the transaction occurs, then the test or the number of tests which you will perform will be completely different. You will have to take a sample based on the number of population and then ensure that the entire period is covered. Another important point is please ensure, even if you are doing an interim audit for say 8 months, 9 months, please ensure that the entire period is covered, because the control has to operate throughout the year as well as effective from an ICFR perspective as at year end as well. So we should ensure that the period is covered. We should ensure that the length of, interim testing if done, we cover a maximum period there. And rather than covering 5 to 6 months, it would be recommended that you cover 9 to 10 months in the interim itself. Another important aspect is how you are testing that control, whether it is a combination of inquiry, inspection, or you are able to reperform a control, because that is how you will decide what level of evidence you have been able to achieve from a control testing. So relevance and reliability of audit evidence depends on how rigorous the control has been implemented by the management and what procedures we have performed as an auditor to conclude that the control is operating effectively. Timing of test of controls is again very important. Whether a control has to be tested at a point in time or over a period of time again is very important. Controls like physical verification, obviously they will be performed at a particular point in time. Rest of the controls, we should make sure that controls were effective over a period of time. So over a period of time means you will have to test the samples during the entire period. Let's look at substantive procedures. So we spoke a lot about control testing, that if we have to respond to the assessed risk, the first and the preferable approach would be to go through control testing. Perform a walkthrough, look at the design, and then test the controls. Now, what would be the required level? How will you get the required or I would say the balanced level of evidence? Once you perform your control testing, then you move to substantive procedure. So substantive procedure is required to be performed for each material class of transaction, account balance, and disclosure. Okay. The example of substantive procedure, as I said, would be verification of certain samples with supporting documents, sending external confirmation, recomputing certain complex calculations which management would have applied. These are type of substantive procedures which we would want to perform on each material account balance. Once you perform the substantive procedures or the substantive audit, then you do an assessment. So now you have an evidence from control, you have an evidence from substantive procedures. As an auditor, then you are required to evaluate whether the audit evidence which you have got is sufficient and appropriate. Now, how will you do that? So, whatever information has come to your attention, whether that differs significantly from the information on which the risk assessment was based, is very important. Okay. So, when you do a risk assessment, you had some information, you had some understanding of business basis which you had assessed risk. If that understanding has completely changed during the evidence gathering phase, then you need to reassess whether you have been able to perform sufficient procedures and whether appropriate audit evidence has been obtained or not. Okay, that is very important. Suppose there are certain missing evidences, there are certain conflicting information or contradictory information which you come across, or you note certain discrepancies in audit accounting records. In such scenario, you may have planned ABC procedures, but now you will have to go back, assess the risk, as well as plan further procedures also. So whenever you come across any observations or your understanding changes over a period of evidence gathering phase, it is very important that we do a reassessment of the risk which we have identified. And then we also evaluate whatever procedures we have performed, whether those are sufficient and appropriate to conclude that there is no risk of material misstatement. The sufficiency and appropriateness is again judgmental, but it is very important that, especially wherever you have identified the heightened risk of material misstatement, that you go back and evaluate whether the evidence obtained is sufficient and appropriate. Suppose you are doing an analytical procedure, there may be certain items where there may be unusual movement for which you may not have been able to get appropriate explanation which is corroborated by evidence. In such scenarios, again, you would need to go back and think whether you have missed out on any risk. So basically, what we are trying to say is, though we do a risk assessment at planning phase, at every point in time in audit, you need to reevaluate and reassess in case you come across any contradictory or any information or any, I would say, negative information or any discrepancies. In case you reassess, then reevaluate your audit plan as well. Okay. Whenever you come across any fraud situation or any error situation, don't look at it as an isolated transaction. Try and assess and see whether it would have further implication or the implication could be pervasive on the financial statements. So you may have come across a particular error or a fraud in particular account balance, and you may believe that rest of the account balances are fine, but it may have pervasive implication. So therefore, whenever you come across such situations, don't treat it in isolation. Look at it from a overall perspective and see if there would be further implication on the financial statements. So in nutshell, if when it comes to designing and implementing an audit plan to assess the risk at financial statement level, as we spoke, for an overall response, it is important that we maintain professional skepticism, we assign right level of people, we incorporate unpredictability, the engagement manager and engagement partner supervise the work, and the nature, timing, and extent of audit procedures are clearly defined. When it comes to assertion level, an auditor shall design and perform the audit procedure for each assertion. So control testing also is required to be done for each assertion, especially when you are issuing an ICFR opinion and relying on controls. And substantive procedures also are required to be performed for each assertion. When we are using a combined approach for each assertion, we need to do each type of procedure. The third part is then evaluating the sufficiency and appropriateness of audit evidence. So, basis this, evaluate whether we have the appropriate evidence and our risk of material misstatement is mitigated. Conclude whether we have got sufficient evidence. In case no, then assess the implication on reporting. So, assess whether there is a there would be a qualification which would come in the financial state in the audit report or disclaimer, or whether you need to do further procedures only to satisfy yourself. That entire evaluation has to be done once you collect the evidence through control testing and substantive audit procedures. So in nutshell, this slide summarizes what the ISA 330 is trying to say. So if we look at the overall responses, SA 315 will identify the risk, and then for the identified risk to response, SA 330 would require us to design and implement an appropriate plan to mitigate the identified risk. Now, having done all the work, another very, very important aspect, which as an auditor we should always keep in mind, is documentation. So we may have identified risk, we may have done the procedures, but if we have not done a sufficient documentation of the entire evidence gathering activity or of our entire response, we will not be able to demonstrate that we have done sufficient work. So it is extremely important that we document our overall response to the identified risk at the planning phase for each line item at an assertion level. So for whatever risks are identified, a brief audit plan has to be documented in the audit file. We need to then link those procedures when we perform the procedures. So what we are trying to say, at planning phase, if you would have planned 10 different procedures on trade receivable, you need to ensure that you have performed those procedures when you are doing an evidence gathering. In case you have not been able to perform certain procedures and you still believe that you have collected sufficient appropriate audit evidence, you need to specifically mention why you believe those procedures are not relevant, or you have got sufficient evidence only through the 6 procedures which you would have performed. So make sure whatever you plan, you perform those procedures. In case you still believe you need further evidence, then go ahead and perform additional procedures, but document why you perform those additional procedures and do a risk reassessment of the risk. It is also very important that once we conclude our control testing, once we conclude our substantive procedure, whatever is the result, we include the conclusion in our audit work papers or in our working files wherein we have performed the results. So suppose in one of the controls there is some deficiency which is noted, and the control turns out to be ineffective. We need to conclude that in our audit work paper. Then we need to assess the impact that we are not able to get sufficient evidence from that control. What are we required to do? We need to perform maybe more substantive procedures. Once we perform the substantive procedures, then we conclude that okay, sufficient evidence is gathered, but we need to still assess the impact on ICFR reporting if the control is extremely important and there are no compensating controls in place. Another important point which we should always keep in mind is when we perform substantive procedures and we come across certain exceptions or certain discrepancies, we may conclude that those are not material. But always keep in mind that when you are testing a sample of the entire population, extrapolate the differences to the entire population and do an assessment whether the differences are material or not. All these conclusions are extremely important, because till the time you're not concluding these two procedures, you will not be able to conclude whether sufficient appropriate audit evidence has been gathered or not. Another important aspect is if you decide to use audit evidence related to control effectiveness obtained in earlier years, we need to document the conclusions reached about relying on such controls that were tested in previous audit. So if you are following a rotational control approach, a detailed documentation why you had followed that, what was the level of evidence required then, whether you have been able to get that evidence, and what is your conclusion when you are relying this time on those controls, is everything is required to be documented in the audit work papers. So this brings me to the end of our today's session. I have tried to cover the important aspects of SA 330. Hope you have found this useful and important.
Thank you so much, madam, for such a wonderful deliberation. On behalf of AASB of ICA, madam, please unshare the screen, please.
Yeah.
On behalf of AASB of ICI, I extend my heartiest thanks towards both these speakers, ma'am, for such a wonderful deliberation. So let us start the question answer session. May I request Mayank to please initiate with the question answer session. Mayank ji.
Yes, sure, sir. Firstly, I would like to ask one few of the question to first speaker. If some information or documents are being asked for during the audit and the client is neither refusing nor giving the same, is it desirable to put the requirement in writing to the client? Like customer is neither refusing and nor is providing the same.
Yeah, so in such scenario, if you are not getting the information, it is as good as he is not refusing, but he is not giving. So he is not actually saying through, he is conveying through action that he is not giving, right? So here it is non-receipt of information. And important thing is, any requirements that we raise to the client, everything has to be in writing. There cannot be verbal requirement unless it's a small requirement. And so the generally what we do is that we list down all the requirements in an Excel sheet and then ask the client to put a tentative date and send it back to us. And then as and when we keep getting the requirements, we keep updating the sheet. So that way we also have completeness. We can actually monitor what is being received.
Basically, do we need to put the same in writing?
Yeah, absolutely. That's what I said. It has to be in writing, because one of the things that companies that says is that have you sought all information and have you obtained? So it will be a proof that you have sought. If not, then tomorrow he may argue that you never asked for the information.
Right. Exactly. Exactly. Right. And next one, ma'am, who is primarily responsible to identify the risk? Is it management or internal auditors?
Management, they are running the business. They have to identify risk. And one of the things in your IFC framework also, the first thing is risk assessment. They have to assess the business risk, they have to assess the environmental risk and other things. then the audit risk is being identified from the business risk, and over and above whatever is the risk that we have to identify.
Correct, correct, correct. Okay, once it has been identified by the management, the
Yes, yes,
auditor
yes.
can do their work. Yeah,
Yeah.
right, right, right. And ma'am, Tushar, you can ask your question. Then we can move to next speaker.
Sure, Mayank. Padmashri ma'am, there's a question regarding whether, if you can share some examples for risks other than the significant risks as per SA 315.
Yeah. So significant risk, I gave two examples. We want other risks. So there may be a risk of obsolescence in inventory. Inventory may not be a very significant item on the balance sheet, but however, it is an item above the performance materiality and we have to check. So there is a risk that obsolete inventory is not being provided for properly. Checking of impairment indicators, even in a healthy company, may be a risk because, it's not only that if it is loss making, we have to check for impairment. There may be other factors wherein you will have to check. Going concern is another thing that if it is significant, it can actually change the balance sheet and the audit report completely. But it is a risk that you have to always keep checking at the beginning and at the end. So there can be any number of risks, which not necessary everything can be significant.
Absolutely. And just in continuation to this, ma'am, there's another question that whether you can provide any risks assessment measures and control measures for banking industry in specific.
Yeah. So in banking, so as we said that there are two risks that every firm considers. One is fraud in revenue recognition. Second is management overhead of control. These two still exist, but then fraud in revenue recognition may not be to that extent. However, there is a significant risk in banking industry, which can be your NPA recognition as per the Basel norms, right? As per the master circular. Then there can be this provisioning norms on the various kind of sectors. Then there are regulations with respect to how do they invest and what is the category and how much they can carry forward and what are the types of investment that they can do. Then if there is a future and options section and things like that, then there are treasury risks that can be included. So these are some of the things at the top of the mind that I can
Yep.
recall. And then interest rate fluctuation.
Yep.
If the bank is heavily dealing in forex, then that can be a risk as well. So there can be a list of these things, but mainly advances NPA and the limit testing.
Basically, combination of credit risk, market risk, and all
Yeah, and
the
then
other risks.
obviously regulatory risk being the highest.
Yep.
If RBI has done some inspection, if they have come out on some points, and if the things have not been complied with yet, then that becomes a significant risk again.
Got it. Perfect.
And ma'am, one more thing. How to connect COSO with risk matrix?
So if we see the guidance note on IFC, it is actually written on the basis of elements that are there in COSO. So internal control that has to be put in place by the management is nothing but COSO. All the elements that we are talking about is control environment, risk assessment, communication, information, monitoring. All these are elements of COSO. So basically, it's already intertwined and it cannot be separated. Actually, the entire framework is based on COSO.
I don't have any other questions, Mayank, for SA 315. I can relay some questions to Shraddha ma'am if you can take up,
Yeah,
please.
yeah,
Yep.
Tushar.
Ma'am,
Please, please.
Thank you.
ma'am, I think there's a lot of buzz around audit efficiency because I can see three questions around the same thing. So I'll just articulate that whether there's a way to combine the population for internal controls and substantive procedures within the same testing if we can combine them.
See, there is a concept called as dual purpose testing, which is there where you can combine the population and perform test. But what the audit team needs to take care of, or what an auditor needs to ensure, that the purpose of the two tests is completely different. So the attribute testing is completely different when it comes to control. When it comes to substantive procedures, the purpose, the objective, and attributes are totally different. So you can combine a population, you can perform dual purpose testing, but you need to ensure that you take higher of the two population and not lower of the two. and the objective of each test is different, so those objectives are met. So for an example, in control testing, maybe you may be looking at approval, whereas when it comes to test of details, you may want to completely reperform that activity and test it. So the objective will be completely different, though the population may be same.
Got it. So I think you answered the other question as well, that if control test for an assertion is performed, do they need to perform a substantive test as well? So that's
Yes,
the purpose
yes,
of both the testing is different. Yep.
yeah.
Yep. And ma'am, there's a generic question. I don't think it directly relates to both the standards, but a limited company set off other income against the unbilled revenue, and they've shown it as a net amount in the financial statements. So and they're not in a position to rectify this. So is there a way an auditor can respond to this?
So, sorry, you said they have netted off other income
Other
with
income
unbilled revenue.
against unbilled revenue. So was the debit side, one was the credit side. So they probably netted off and have shown it as a net amount
Okay, and the auditor, the management is not willing to
to rectify
change the
this.
presentation. So
Yes.
I think the auditor basis the materiality should assess whether disclosure and presentation from that perspective is important. I mean, is material, and then post misstatement. If they believe that this is leading to material misstatement from reporting perspective, they can even have a qualification in the audit report. But what I would suggest, since it's a disclosure matter, you need to first assess whether it is material. You need to understand the rationale why management doesn't want to do it, whether it is affecting any of their ratios, what is the reason why they don't want to do it. Have a discussion with those charged with governance, because we are talking about a listed company, to try and get it rectified. If not, and if it is a very significant amount leading to auditor, you should report it in your auditor's report.
Absolutely. And ma'am, this should have a effect on the controls report as well.
Yeah, yeah, yeah.
Yep.
It may have an impact. Yeah, it may have an impact
Yep.
on controls reporting as well.
We need to assess the deficiency around
Yeah.
the control. Yep.
Yeah.
Got it.
The most important aspects when such disclosure related items which comes up is what is the management intention behind it. At times they may be having certain ratios from bank's perspective, because of which
Yeah.
they may not want to
Yes.
do certain things. So there
Absolutely.
it becomes more important that we bring it to the attention of those charged with governance, and we assess all the implication, including the control implication, and report it in the auditor's report.
Got it. Got it. Sure. No
And
more
ma'am,
questions from my side. Yep.
yeah, ma'am, one more question from my side. Basically, this is somewhat a general question. Like, as we'll not have a relative data of all vendors and customers, how is it possible to find out the relationship, except by scrutinizing the form submitted by the directors?
So we were talking about completeness of related parties, right?
Right. Right.
Yeah. So, see, when it comes to vendors and customers, we should have the information of all vendors and customers available to us with whom transactions have taken place, honestly, because that's the list of transactions which you would want to look at. When it comes to identification of related party, ideally we start with the review of annual report, where we start looking at, and then we look at the MBP1, DIR8, the directors information, relationship information which we gather. Then we do a overall search to identify whether there are any other parties which could be covered into the related parties. So the main source of information is the director declarations which are given by them, minutes of the meeting which are there to see whether any director has specified anywhere about his relationship, annual report which is there in the public domain of earlier years, and then obviously concluding whether the list is complete or not. But before you as an auditor decide whether it is complete or not, it is important that you go back, ask the management to provide you with the list of entire related party, ask them how they have ensured the completeness of that list, and then perform procedures around it. If you believe there would be certain transactions which are missed out, or which are certain parties which are not identified as related parties and are there, you should obviously take the list of entire vendor transactions as well as customer transaction, try and find there whether there is any relationship which is there. Because see, now related party has become very tricky with the new SEBI LODR requirements which has come up with purpose and test effect. So it is very, very important, if you are especially talking about a listed company, that you sit with the compliance officer, understand and challenge the process which management has in place to ensure the completeness of related party list. Obtain a comfort that what procedures they have done as a company to ensure the completeness, and then start performing procedures around it. The moment you have doubt, please, I would say, please dig it down to ensure that you are completely satisfied that the party is not a related party. Because related party is a very, very important topic from a regulator's angle, as well as an auditor. We need to be very careful when it comes to evaluation of RPT transactions.
Exactly. And one more thing, ma'am, going concern aspect is also important. Also, we must see if the client is able to revise his selling price for corresponding increase in the cost. Like
Yeah,
if
sorry,
the answer is like, yeah. Yes, ma'am.
I missed, I think your voice was breaking, Mayank. If you can repeat the part
Yeah,
around
sure,
going
ma'am.
concern.
Like going concern aspect is also important.
Yeah,
Also, we must see if the client is able to revise his selling price for corresponding increase in his cost.
yeah.
Yeah.
Correct, correct.
Like
So when it comes to
if he's
going
not
concern, see,
able
I
to,
will tell you what happens is sometimes you will find a situation where the purchase cost may have gone up. Okay, say industries, automobile industry, very dependent on metal prices. So the purchase cost may have gone up, but as a company to retain the market share, they may not want to increase the selling price. Obviously, you will try and see what is the strategy, whether they are trying to gain the market share, what is the financial position of the company, whether they are able to absorb that cost, additional cost, without having any impact on going concern. So not always, if you're not able to increase the sale price,
like in
it
case
would
of
lead to going
government
concern.
tenders as well, कि the price is
Yeah.
fixed. They cannot increase as much as the cost is inflated. Whenever
Yeah.
like
So in
they are not
certain
increasing
industries,
the selling price in
yeah,
corresponding to.
yeah. In certain industry, there may be a heightened risk in such scenarios. Suppose you have entered into a contract for say 20 years with the same price, and then the asset which you are required, say especially the renewable energy industry, this often happens that they do competitive bidding. There is a lock-in in the price, and then the raw material prices goes up, or I would say the capital investment which they are required to do that goes up. There, one is going concern aspect. Definitely, the most important aspect is impairment at that point in time of a particular asset balance which is there on financial statements. So whenever the situation arises, there's no one fit solution for all, but you need to assess whether it is impairment of asset or whether it is a long-term impairment, long-term impact on going concern. So the judgment has to be definitely applied by the auditor.
Right, ma'am. And one more, ma'am, question, one last question, in fact. Can rotational testing approach of controls also be permitted for significant risk relevant to an assertion?
No, so see, generally rotational approach is not permitted when we talk about significant risk relating to fraud. I would generally suggest in Indian scenario, we try and avoid using rotational approach for even significant cycles. So rotational approach, if you want to decide or if you want to use it for low risk items, use it for very routine nature items or routine nature, I would say cycles. Say, for example, for certain companies, payroll may not be at all significant. The cost may not be very significant considering the size of balance sheet. For such cycles, you can go ahead and still see and use the rotational control. Otherwise, though the guidance note I understand allows, but we should try and see. We should be very comfortable about the controls which are operating in the company before you take a call that you would want to go for a rotational approach, because we are issuing an ICFR opinion. So for significant risk, for fraud risk, you will not be allowed to take a rotational control approach.
All right, ma'am. Thank you so much, ma'am. Thank you so much, Shraddha ma'am and Padma ma'am, for sharing your valuable input on the essay 315 and 330. And thank you so much, Sanjeev sir and Anil sir, for giving this opportunity to us to act as a moderator in this seminar. Now I invite Anil sir to formally thanks or to give a formal vote of thanks to our guest speakers. Anil sir.
Thank you so much, Mayank ji, for wonderful coordination of this webinar along with Tushar ji. Thank you so much from the core of my heart for moderating this webinar. I also thanks both the learned speakers, CA Padmashri Castro madam, as well as CA Sharda Kipsara madam, for giving us this consent on a very, very peak period of audit committee meetings, as well as one meeting is there, another meeting is there, and Padmashri madam has just landed today from the official overseas meeting of last so many days, and she has given her consent that okay, I will speak for 1 hour, and she is here for a complete 2 hours. Thank you so much, ma'am, for giving your consent for this SA 315, and Shada ma'am for SA 330. And it was the wonderful deliberation, and you have covered all the aspects relating to both these standards. So, on behalf of AASB of ICI extend my heartier thanks once again towards both the learned speaker as well as both the moderators, Tusharji and Mayankji, for moderating this webinar. I also thanks all the participants of today's webinar, and I request all the participants to please join one more session of this series on 30th of this webinar, special purpose reports as well as certificates. We will organize the next webinar on 30th at 4 p.m. and the topic would be the reports and various special purpose reports and certificates which are to be used. So once again, thank you so much everyone for being here. Thank you so much.
Thank you
Namaste.
so
Thank
much,
you.
everyone.
Thank you,
Thank you.
ma'am. Thank
Thank you so much.
Thank you so
Thank
much,
you.
sir.
you.
Thank you, ma'am.